Well, good morning, ladies and gentlemen, and welcome back to the Wilson Weekly with myself, Graeme, Holm, and the amazing Dr. Andrew Wilson. And I believe this week is episode 53. Good morning, Doc.
Yes, hello, Graeme. Thank you very much for that sparkling introduction. And don't the episodes just fly past? 53.
They do indeed.
Yeah, it's a movable feast, of course, the property market and the economy. And yesterday we had the big announcement, yawn, another pause. So 5 pauses in a row and 6 out of the last 7 months. You know, it's I guess we've certainly reached the peak of the current cycle. I think we could say that the current cycle's peak. So whether we go down or up for the next cycle is interesting. But we've had some, will be, fascinating. But we have had some interesting data out over the last couple of weeks, which we'll discuss today. And certainly, I think it's the clouds. It's getting cloudier for the RBA. And of course, we had the new governor do her thing for the first time. Not sure we noticed a big difference, but we'll see how things pan out.
What's your I mean, I know we're going to cover it, Doc, but before we get into the slides, what's your take on pause after pause? We've got record low unemployment. Jobs,
yeah, I know.
Jobs are pumping along. Everyone, the participation rate, I'm sure, is probably still high. You'll take us through it, I'm assuming.
Absolutely, yeah.
I mean, is this pause just a wait and see if we just keep holding and take stock, and then could we be in for a big whack, or what do you think's happening here?
Well, it's this is the judgment call that the bank has to make, Graeme, and that is we're waiting and seeing, but have we got to the point where we've done enough to beat inflation? Now, inflation has come down until recently, which is a concern, has come down from its post-COVID peaks. But really that was all about the supply lines adjusting post-COVID, getting back to normal. It wasn't about interest rates. And now we've seen the other sort of end of the pineapple, where the increase in interest rate in prices is causing, in a very tight economy, a tight labour market, is causing prices to rise because employers are having to cover higher wage costs with higher prices. And this means services prices are now the big concern. They're a concern in the US and they're a concern here because we're starting to see that being the main driver of inflation. But there are other factors now going forward that are also of a concern. And that, of course, is the price of oil, which is now above $90 US a barrel. And, we were starting to push down towards $60 US a barrel not so long ago. But now we're heading back up to, maybe $100 US a barrel. And when we look at the pre-COVID position on oil, it was around about $30 or $40 a barrel. So really these are big numbers. And of course, as we know, the price of fuel is really deadly when it comes to rising inflation, because everybody's got to pay for higher fuel costs, not just, to take the kids to school, but it's also all the delivery stuff as well that, is a problem, and that passes on to higher prices.
I tell you what, Doc, I know when times are tough, because I had a meeting with someone at a local Chinese restaurant the other night, and you get the old doggy bag, right? They go, they put it in a container for you, or they give you the container. Well, this one, it was 50 cents a container. And I'm thinking, times are tough. If you want to take 2 doggy bags, it's going to cost you $1. And I'm thinking, is the cost of goods and service and inflation, or maybe just that particular restaurant was taking the mickey, but that's a bit of an interesting thought process if you've got to pay for the container to take your food away.
Yeah, I'm not sure there's a lot of costs involved with those plastic containers, mate. The base price is probably around about $0.01, per container. So,
maybe a very astute businessman and businesswoman, maybe. But I had a good chuckle.
Well, I guess the perhaps one of the consequences of that is you just order less next time. So you make
there
sure,
you go.
So you pay for less food, and that's really going to hit them, below the belt because, I'll just have one special fried rice, thank you.
Well, just to loop that back around, that's like the law of unintended consequences when you mess with the housing market.
That's right. So, look, I'll just stick with the chicken chow mein and one special fried rice, thank you. And there's $50 less, all for the sake of a
50-cent container, 1 cent container,
which costs them a cent, and they'd probably throw them out, after a while anyway, because, anyway. But look, that's the nature of the economy, isn't it? And this is the problem for the Reserve Bank, that they're waiting to see some signs that higher interest rates had worked. There are no signs, Graeme. I'm sorry. And we'll go through the data today, but there are no signs that higher interest rates have worked. As I said, inflation has fallen until recently. But it would have fallen anyway because it's the adjustment from the lack of supply with all the demand that we created through COVID stimulus packages. So, but the Reserve Bank, basically they cut and paste their statements from month to month. I guess you've got to do that because not a lot changes. But next year we're going to have fewer meetings, so it'll be less of the cut and paste. They just sort of add anything that's differentiated itself over the month in terms of the new data.
Well, they might have to cut, paste, and add a whole paragraph since there's less meetings next year.
Yeah, that's right. And it might have to be more in sort of context, in terms of what's going to happen. But maybe to be less in context because they've got to face questions from the media, or the governor has to face questions from the media, which is going to be really interesting.
This is going to be interesting. I mean, let's be clear, Doc. I was having a giggle last night sharing on a live webinar. As recently as February this year, I pulled up some articles in the media that was still saying not 10, 20 to 25% house price drops this year. In February this year. February. Now, I think you were the first to come out with the data for me at the end of June, maybe 28th of June, that the capital cities were about 3 point something for that half. But February, they were calling 20 to 25% crashes, and it was up 3 or 4 at June.
Yeah, well, and I think we're going to, I've just, we run data here, of course, Graeme, as you know, on a daily basis. And, of course, we've just moved into October, so happy October. And the latest October quarter, which, of course, doesn't include a lot from October, but nonetheless, it's taking out the winter markets of June. The latest data has Perth, Sydney, and Brisbane all on track to record double-figure price growth this year.
Well, sorry, what was that?
So we have double figure. That's 10% plus this year. On track to this point. Of course, things can change, but at this point, the trend is clearly there that the December quarter this year versus the December quarter last year in terms of house prices for Sydney, Brisbane, and Perth, and will perhaps be 10% plus higher than it was over the year. Versus December quarter last year versus December quarter this year.
So the main headline we've seen all last year, Doc, was 21-22. We're saying house prices to crash 10% in 2023. Now, then, if they're going to be double figures for most of them, they're going to be 10% growth. So we've got 10% loss, 10%. We're 20% different here, and in the wrong, it's the wrong direction. 10 down, 10 up. How? I know we talk about it, but honestly, how can they get it so wrong? Or is it deliberately, intentionally wrong?
Well, they might say that just to cover themselves. I just think it's ignorance, Graeme, to be quite honest. And I mean,
or is it just a cheap headline, Doc?
It is a cheap headline. Well, we know it's a cheap headline because the media loves those headlines. And, despite the fact that they've been wrong cycle after cycle with these ridiculous doom and gloom forecasts, they continue to do it, right? Because, you'd think, we got it wrong 19, we got it wrong in 21, we got it wrong in 22, we got it wrong in 23. You'd think we'd have a bit of a think about what our next forecast was to make sure we could get it right. And when it's the big banks whose business is mortgages, the housing market, you'd think that they'd be absolutely spot on, but they're not. They're actually the worst of, and this again just begs the question, they maybe just don't care. And if they don't care and people are making decisions based on these silly, terribly erroneous bank forecasts, then, maybe we need more competition in our banking sector if there is no accountability for these types of mistakes, which will affect consumers who regard the banks perhaps and certainly mistakenly in terms of their forecasts as a source of reliable information. What can you say?
It's funny, Doc, if you ask somebody if they trust the bank, they'll say no. Yeah. But they'll trust their economist forecasts, or they'll trust that the product they have works. So we distrust the bank, but we also trust the bank. It's quite an abstract. It's an anomaly. It's an enigma.
Well, we have to trust them, Graeme, because there's only 4 of them.
Yeah.
So there's no difference between their product because there is only 4 of them. So of course, whoever's holding our money, we've got to trust them. We've got to trust them, don't we? If we don't trust them, what are we doing? Putting it under the bed, buying gold bars. But as I said, we've got to trust them. But this is the whole, environment of where we have a market power which is skewed, in favour of the enterprise, and we've only got with such an important industry such as finance, we've only got 4 banks, and it's it works for us. It's good because it means the banks don't take risks, so they won't let us over borrow, and that's really good. But the government, and God help us if we put any faith in the governments these days, heaven help us. But you should be taking the side of the consumer here, and at least ensuring that there are protocols that banks must look after the consumer's interests. Look at our airlines, Graeme. I don't want to get on that one.
Oh, well, should we?
Well, we are moving into tangential areas. But there's another example. When you have all that market power, the consumer can suffer because there's no competition, and big businesses get feather-bedded, particularly in, essential services such as transport and finance, and that lack of competition ends up burning the fingers of consumers. So where are you, government? Can you do something about this? You get the gold pass, you get the big car, you get the wages, you get the accolades. Can you just start to earn it, please?
Well, I tell you what, Doc, both airlines and banking in Australia are ripe for a Richard Branson-esque entrepreneurial absolute challenge somewhere. You could come in if you had the capital to, and this is the thing, Doc, even in banking, I do a lot with non-bank lenders where the money comes from the same super funds, hedge funds, same place the banks get money from, not just deposit accounts. But we really are ripe for someone to come in and actually compete and provide another offer to the consumer. Yet it's such an oligopoly in banking, as you say, that you can't compete. They just won't let you in. They make it so bloody hard, you just can't get in.
Well, that's right. You have to take short-term risks, Graeme, and make a short-term commitment and medium-term commitment financially for no real guarantee of success. And this is the problem. I think it's really up to governments to ensure that, okay, it's fine to have oligopolies acting in essential services, particularly finance, because it saves us from risky borrowing, and that's fine, and we want that. We don't want the US model here, thanks. But, you've got to balance that out with some mechanism to ensure that market power is not abused, right? And I think I think their appalling record in terms of housing market forecast, economic forecast, is just a reflection, that they're not incentivized to get it right. Get it right. But to get it so wrong, they get it so wrong, mate. It's not as though it's a little bit wrong. And okay, that's fine. We understand that. This is a difficult area to be involved in, economic forecasting, because things do change. But as we've pointed out, Graeme, over and over and over again, the historical record shows that we've only had 4 years since 1987 where house prices have fallen. 4 years since 1987. That's, that's a long time. That's, pushing 40 years, mate, of data. And we've only had 4 years. And the worst was 5.5% over the year. And this year we're going to get, close to 10%, certainly well above 5%.
Well, again. That's scary, Doc, because if you think about right now, right, we do some math, $500,000 home loan over 30 years at 6%, that's going to cost another, not just the $500 you borrow, that's going to cost another $600,000 in interest. It's not 6% per annum. It's actually 120%. You're going to pay back 1.1 million. You're not going to borrow 500 and pay back six. You're going to borrow 500 and pay back 1.1 something. And if these guys and girls are so trusty, get it so wrong on every single forecast, on everything they put to market, yet we trust them to pay back not just the 5 we borrow, but 1.1 million over 30 years. Like, it's really starting to concern me that we're just bobbling along like a rubber ducky down the stream. There's no competition. There's no alternative. What are you meant to do as the everyday Aussie family?
Well, can I splash a little bit of petrol on this bank-burning bonfire, Graeme?
Oh, please. I'd love it too. Go on.
Well, we are going to speak about interest rates, of course, because yesterday was the decision by the Reserve Bank, again on hold, no surprise there. So now we're at 4.1%, Graeme. That's the official rate at the moment. Now, the last time we had an interest rate cycle was back in 2000, a rising cycle. That was back in 2011, 2012. Of course, that was at the back end of that big mining boom where we did have inflation and too much demand, not enough supply, when we were exporting coal and iron ore willy-nilly to China.
Yeah.
So the Reserve Bank put up interest rates. We were the only place in the world that were putting up interest rates in terms of advanced economies at that time. And if you remember back, Graeme, and people forget, the Aussie dollar actually smashed through the parity barrier with the US dollar. Our Aussie dollar was almost worth $1.10 US, which was quite remarkable because we hardly ever, if ever, at that level. And it was because our interest rates were so much higher than the US and the rest of the world. So it was sucking in capital because everybody wanted to invest in Australia because their interest rates were going through the roof where everyone else was cutting rates. So we had that Aussie dollar parity. So at that time, right, the official interest rate was just under 5%, right, in 2012 at its peak, right? So it peaked at just under 5%. Now we are just over 4%. So official rates were 1% higher, more or less, at the peak of the previous cycle, right? So do you know what the average mortgage rate was then? The average mortgage rate was 7%, right?
Oh, so hang on. So there's a bit of a margin going on right now.
Naughty, naughty, naughty. So what's the average according to the RBA?
Doc, you better be careful because oil a barrel, petrol prices right now, you didn't just pour petrol. You've got the pump and you're just spraying it right now and it's expensive. There's a little bit of consumer gouging going on here when you look at these margins. There's a discrepancy.
Well, the average, according to the RBA, the average mortgage rate now, and that's variable owner-occupied standard rate, same measure, we use the RBA's standard measure, which was 7% back in 2012 when official rates were just under 5%. It's now 8%, Graeme. So we've got an 8% mortgage rate, but a 4% official rate. So as rates have increased and decreased over that period, we're paying an extra percent in our mortgages.
Isn't that
Right?
interesting that the banks have figured out a way in all the ups and all the downs?
Yeah.
The majors have been able to develop a business model that not just retained a margin, but increased it by an entire 1%.
And look, Graeme, let's be quite frank here. You know, they do it tough, the banks.
Oh,
you know, they're really doing it tough. You know.
I know, Doc.
We've got to give them that extra $1 trillion in profit, whatever it was that they made.
Yeah.
You know, because, you know, they do it tough. And, you know, I don't know how those chief executives survive, you know, on those wages. You know,
the wages and the stock and the incentives. I mean,
what is it, 10, 20 million a year? You know, it's a tough gig, but so one can understand the temptation perhaps to ensure that they're maximising their margins. So please give me a break. So where's the outrage here? Where's the, you know, maybe we do need more competition. Where's the government saying we're here to look after the little guy and the little girl, right? We're here to protect them from, you know, too little competition bruising the consumer. Where's the government here? Well, you know, they've got other fish to fry, haven't they, Graeme? You know, but which is, you know, really. But don't worry about your mortgage payment, particularly when we've got the highest inflation in decades, you know, and we've had 12 interest rate rise over last year. Don't worry about having to pay that extra 1% on your mortgage through the, you know, the interest rate creep.
I don't know what you're talking about, Doc. What extra 1% margin? Look over there. The smokes might be a bit of smokes and mirrors going on in the banking system here, mate.
Yeah, well, good luck to him. And it must be tough, you know. Do I buy the 40-foot yacht or the 80-foot yacht? You know, it's you know,
times are tough.
The shadow in the Loire Valley, you know.
All
those decisions, you know.
They've been doing it so tough. Bit of a Wagyu and red wine, I'm sure.
Shall we get on to the main game?
we better get into it, Doc. We can talk this all day. So
and we'll probably get some writs being landed.
Yeah, I've just had 3 banks email me saying we no longer work with you, Graeme. Oh, great. Well, whatever, FTB. Anyway,
well, they can do that. See, that's the whole point, mate. They've carte blanche.
Good luck to them.
Well, this week's data from My Housing Market, and it has been a busy week, and we've covered a lot, and we'll sort of digress but then go over some of it again. And of course, My Housing Market is all about the current state and future prospects of housing markets, particularly the current state. And we did discuss last week, Graeme, of course, the latest house price data and unit price data, which is interesting. No surprise that although prices are still rising generally, that they have flattened a little bit over that winter period. We say there was a number of reasons for that, not just the seasonal impact, but also, of course, higher prices start to push buyers out of the market. A lot of that pent-up demand has been satisfied. Of course, higher interest rates, of course, eventually as well have their impact on affordability. And it was, you know, as I mentioned at the beginning, the winter market. So that was the latest data. Of course, heard first here, the September quarter data just a week ago. And next week, Graeme, we'll look at the latest rental data for the month of September, which is quite interesting. But we did have the Reserve Bank meeting yesterday again, as we've discussed. Rates paused again, no surprise there. Rates on hold over October. But the latest data, this is, again, you know, no sign. If we're waiting and seeing, we'll be waiting and waiting and waiting. And it's going the wrong way, RBA, at the moment. But certainly the labour market remains very strong, which we've discussed. Unemployment is still near record lows, 3.7%. Jobs are surging. We created over 60,000 jobs, Graeme, over August. And the number of unemployed was down by 3,000. So, you know, that's a great result. Again, we've got to question some of that ABS data. It is sort of flip-flopping everywhere, although September versus August was quite settled for the first time. We didn't have that sort of roller coaster month to month, up and then down. But the interesting point with the labour market, Graeme, was that we had a record participation rate, which you alluded to, which means that we had a higher proportion of the potential workforce actually working. If we had have had the same participation rate, in other words, we didn't have those extra workers coming in, the unemployment rate probably would have been a new record low below 3.5%. So it just doesn't get any better than that. We also saw, and we're going to discuss this in a little bit more detail shortly, retail sales are still rising, still not rising at the rate of last year. But last year, mate, was crazy. You know, the retail sales data. They say, oh, it's flattening out. Well, it's like, you know, we've still got massive levels of retail sales occurring, but they're not growing at the rate they did last year because we're not getting money thrown at us in terms of COVID stimulus. So, and the retail sales are still rising, albeit slower, but they remain significantly above pre-COVID levels. And that you know, you got to understand that the retail sales is embellished. So the level of retail sales is embellished to some degree or overstated because we've got extra migration. So there are more people spending, right? So you've got to take that into account, the extra migration and inflation, because it's the value of retail sales that's measured. And we've seen, you know, inflation rising at the best part of 10% over the last 18 months. So you've got to take that into account as well. But even when you do, it's still a very, very strong result. And this is what the ABS is saying. Oh, yeah, but, you know, we've got to, you know, it's still overstating. It's trying to say that consumers are paring back because of rate rises. Well, the data doesn't support that. And the ABS has got to be very careful about moving into this commentary position, because if they get it wrong, which I think there's certainly question marks about what the ABS has been saying recently in regard to what the data means, then they look like they're pushing a particular barrow. And we can't have that from the Commonwealth statistician, Graeme, who have to be, you know, seen to be completely objective. Anyway, and inflation, Graeme, can you believe inflation increased the latest monthly data? So after falling consistently, headline inflation actually increased. So, you know, but of course, hey, I'm cheering steady rates for the consumer out there because they don't want to have higher mortgage rates. But the role of the Reserve Bank is not to keep the consumer happy in the shorter term anyway. It's to beat inflation. And I think that, you know, not just the RBA, but most central banks have given up in some degree on really getting rid of inflation. And I think that we're going to have to live with higher inflation for longer because the appetite for higher interest rates is just not there. And what worries me is if we start to get a breakout, as we're starting to see now with fuel costs, and then inflation continues to rise, what are they going to do, mate? You know, if they keep putting it on pause month after month, and then it's like, oh, it's actually breaking out again, inflation. We haven't controlled it. Oh, we better whack up interest rates by 0.25%. Oh, yeah, that's going to do a lot of good. That'll change the whole. What I'm saying is you can't just then resume and think that'll add on to the previous one.
Well, no, they'll have to be more aggressive, Doc. This is where they go, exactly. 0.5 or 0.6. They'll come out and hit it with a sledgehammer, and people will shit themselves.
Yeah, and what that means is that they drop the ball by pausing too soon. That they should have continued to raise rates if this occurs. I hope it doesn't.
Yep.
And that would have meant that they've dropped the ball because they paused too soon, and you know, probably blame the ex-governor, you know, for that one too. He'll get blamed for the weather.
He's gone now, but yeah.
Yeah, but I'm just saying that, you know, this is the jeopardy that's involved now if you go to pause too soon, because the hardest part of quelling inflation is the last little bit, Graeme. That's what is the hardest part. And the economists are starting to realise that, you know, wake up, economists, seriously. Well, anyway. But that is the hardest part, is the last bit. And that's where you've got to keep working and not pausing too early, because it only means it's like you didn't take all your medicine, mate. You got sicker again, so you're going to have to up the dose to get rid of it and to get rid of your illness. And the illness is inflation. And as I said, I hope this doesn't occur, but we're starting to see early signs that we're not managing that last little bit of inflation, and it's outside sources that are now adding to this, such as the international price of oil. So good news, another pause. Let's celebrate that while we can, Graeme, but let's recognise, at least by being, objective here, that we need to really see some more results in terms of what higher interest rates are supposed to do, because we really haven't seen anything yet that justifies any sense that higher interest rates are impacting the consumer as they should, to get rid of what is still way too high inflation. So there's our cycle. Graeme, can you see how we've topped out now? We can say we've reached the peak, I suppose.
Yep.
You can see how that interest rate was 4.75% back in 2011 at the peak, and we're at 4.1% now. But as I mentioned, naughty banks.
To the naughty banks, to think we had a rate cut in late 2020. Now, I remember this because they didn't cut variables, the naughty banks. They only gave these what appeared to be low fixed rates with shit comparison rates that was creating what we've called the mortgage cliff. But we had a cut in late 20. A cut.
Yeah. Well, like I said, let's hope that the inflation dragon has been tamed. But I'm a little wary of calling victory yet. And this is what the RBA said in its statement yesterday, Graeme. Inflation has passed its peak. It's still too high. They said exactly the same thing. Well, I have been saying this for months, and will remain high for some time yet. They said timely indicators of inflation suggest that goods price inflation has eased further. We know that. That's due to the adjustment post-COVID, but it's saying that services prices are rising briskly, and fuel prices, this is what they've added in, have risen noticeably of late. And of course, this is where Australia, is having real issues, is that rent inflation remains elevated. Same in the US. But their forecast is still that we're going to get to the back to our target, which is underlying inflation target, in 2 years' time. So we're going to have to live with high inflation for 2 years' time, or above target inflation for 2 years' time. But here we go again. This is as usual, hey, we really don't know what we're doing type of thing. There are significant uncertainties around the outlook. Services price inflation has been surprisingly persistent overseas. Why would it be surprisingly persistent when you've got booming labour markets? You've got to get the boom out of the labour markets, RBA. That's how you stop services inflation rising, and you've got to have the guts to do it, right? And now they're saying, maybe the same could occur in Australia. Well, what a surprise, given those spectacular, unemployment rates and labour market data. So it says some further tightening of monetary policy may be required to ensure that inflation returns to the target, but that'll rely on the data. They say that every month, just to cover themselves. But certainly the uncertainties are increasing, not decreasing, Graeme.
I think they're going to be the uncertainties that are increasing, Doc's the RBA's ability to make a decision and stick with it. We're talking late 25, maybe early 26, 2-3%. Come on. They have to increase rates multiple times. It's almost now like, hey, we're so woke now. We don't, we know it's tough. We're just going to sit for a while. Yeah. And then they can say, well, we sat for a while, but then we had to be hyper aggressive to compensate.
And they'll say, we didn't know oil prices were going to rise, right? Oh, okay, that's fine. But it's services costs we're worried about here. And of course, Australia has its own problems with house building costs and also rent. So there we go. We've had a bit of a rant about interest rates. We'll see what pans out. Let's keep our fingers crossed that inflation will fall. We'll look at the latest inflation data shortly. But I mentioned retail sales. They're up by 2% over the month. They're now 1.5% higher over the year since August. And that follows a 0.5% rise over July. And as I said before, the ABS here, they go with their commentary, are saying that that was actually a record low annual growth rate, right? The trend growth rate over the past year for retail sales. But of course, Graeme, it's coming off and is still at record high levels, right? So, of course, after that massive boom, the trend is going to start to ease because we had record growth levels, right? And we're still, when we look at the chart, you'll see we're still way ahead of where we were pre-COVID, right? And we're still ahead of where we were a year ago. So, we're 1.2%, 1.5% higher. And the ABS has said that, the fact that high inflation, which means higher prices, is overstating actually the current data. So it's actually worse, in their opinion, than it should be because of high inflation and population surge. And that means because there's more people. So, you would expect to have even higher because of the population surge. But we didn't have people prior to COVID. So it's a rebalancing of the market. And as I said, when we look at the charts, look at that, Graeme. This is the chart of retail sales. So we're up over $35 billion in terms of the monthly retail sales, which is 34% higher than where we were trundling along prior to COVID. And we're maintaining now, inflation hasn't risen by 34% ABS. So you can't say, inflation's, accounting for all this. Rubbish. Inflation, goods prices since then have probably risen 10%. But we're tracking, our retail sales are tracking at 34% higher.
This really paints a pretty bloody clear picture. If just me listening to you, working with you for a few years, I look at just this graph right now and take on board what you said that, okay, maybe goods are 10% higher. Rents are higher, fuel's higher, sure. But it all has not grown 34%. So no. I look at just this alone. They expect to get back to the 2 to 3% range and normalize by 25, 26. I can tell you, mark my words, rates will have to go up multiple times in the next 2 years if they want that to occur, because we're spending like drunken sailors.
We still are. And that's the point. We're not spending at the increased rate that we were last year, because last year we had record savings to splurge. We've spent it all, and we've got higher interest rates and more costs, which has constrained our ability to buy at those increased levels. So we're back sort of normalised, and even accounting for inflation and even accounting for population growth, which I think is a furphy to use as an excuse to say, this data is worse than it looks. We are miles ahead of where we were prior to COVID, where we got those massive, unprecedented stimulus packages, which we spent, which was the plan, and that's fine. And now we're starting to settle, but we're settling at 34% higher in terms of value than where we were prior to all those stimulus packages. And inflation, is it because of inflation? No, because inflation over that period certainly hasn't increased by 34%.
You know what might be at play here, Doc? A bit of consumer psychology. You locked us up. You threw away the key for 3 years. We weren't allowed to do anything. We couldn't get anything. Now we've got a bit of money. I want, I see, I want, I get, I buy. I afterpay. Yeah. Maybe there's a fair whack here of people going, live in the moment. YOLO. Yeah. Hey, it could all... it could all be over tomorrow. We could be locked up again. There's definitely some consumer psychology going on here, because we are spending at unseen levels.
Well, that's right. But and the levels are flattening, but of course they are compared to a year ago, because we look at the growth in retail sales over, once we got out of COVID, it went through the roof. That's what it was designed to do, mate. That's what and fine, because we were so worried about the outlook as a result of COVID and lockdowns. We needed to just throw money at the problem. And that's what you do. And that's what created inflation. That's your inflation curve, that retail sales curve there, because we spent so much that we ran out of things to buy. We couldn't find anything to buy. Yeah. So, of course, prices went through the roof because of shortage of supply, which is now starting to settle. So, my advice is to the ABS is be very circumspect about giving opinions on, and rationalising changes in your data, and make sure you are correct, or you're going to look like you're a little bit jaundiced in terms of opinion making. And for goodness sake, if we can't get objectivity in the government statistician well, I'm throwing my hands up. This is just getting to be a little silly. So we had an inflation shock rise over August, Graeme, after having been consistently falling from those high eights at the peak of the inflation cycle. We have been coming down and down. Previous month, we fell from 5.4 to 4.9. But this month, we actually went from 4.9, and this is August, to 5.2. So we moved in the wrong direction. The better news on underlying inflation was that it fell from 5.8 to 5.5, right? So, but let's remember the target is 2 to 3, Graeme, and we're at 5.5. And the bank's telling us, we'll be back to 2 to 3 in 2 years' time. Now, the point to this is where it becomes a little problematic, is that the point to the underlying inflation is that it doesn't include fuel and housing costs, right? So the problem is that that's where the growth was. That that's why we saw higher headline inflation because housing was up again. That's rents was up 6.6% over the year. Food up 4.4%, and there was a reverse. Actually, fuel costs help headline inflation fall because it fell over the previous month, but it was up 7.4%, Graeme, over August, the annual rate. So this is where fuel is now starting to become a problem. I mean, mate, if you go to the Bowser, what is it, $2.20 now a litre?
Isn't it funny? But when we had the fuel tax, we had that excise going on, and they were doing stuff to help. And then it ended, and then very cheekily, a couple of months later, it just pumped back up again to where it was. But no one's talking about it now.
Well, that's right. And let's hope that we don't get the price of oil heading over $100 US a barrel, because that's going to get to be really serious. And the US are now, because they paused too, there's a lot of pressure from markets, to talk down interest rates, And I think similarly, there's a lot of political pressure. Obviously, there's an election in the US next year, and higher interest rates, higher fuel costs are poison for sitting governments, of course. And we've now got a bit of a change in the commentary last week. Yeah, the rhetoric from the Fed. One of their governors was saying, she now thinks we're going to see a number of rate rises this year, which is sort of running out of time. But she certainly thinks that there's going to be more rate rises. And they've been up till recently saying, no. They've been even talking about a cut, which is cloud cuckoo land stuff. But this is driven by an irrational and an irresponsible media, and also the political climate, and we've got to be really wary about this. And of course, Australia's followed suit. Now, I just want to point out, Graeme, that our underlying inflation at 5.5% is 1% higher than the US. So we're actually not doing terribly well compared to other countries, similar advanced economies, in terms of our inflation rate. And yet we went into pause mode sooner than any of them. And we've been in pause mode longer than any of them. And yet our inflation rate is worse than any of them. So, there's some really hard questions coming up here. And I hope the answer isn't just, well, let's blame the other guy. He's the one who stuffed it up and he's gone. I think that there's some real question marks now over the performance of the RBA ongoing. And I'm not sure it's going to be fixed, but let's hope that everything works out going forward, Graeme. So we can finish off now, as we always do, with our weekend auction markets. First weekend of, it was the last weekend of September. And of course, it's a bit of a dodgy result because it was grand final weekend for a start, AFL grand final, NRL grand final. And the other point is public holidays. Victoria had the Friday off, and New South Wales and Queensland, they had the Monday off. So long weekends. Who cares about the property markets? You know what I mean? And we always get a quiet period, and that follows a strong period the weekend before. And if we look back to the previous weekend, Graeme, We know we had some strong results despite a surge in listings, which we get prior that pause weekend, the last week in September. So, no surprise that the results this weekend were lower than the previous weekend because we certainly didn't have the activity both from buyers and sellers because they're on holidays, mate, or they're watching the footy. So auction markets will resume next weekend. We'll have higher listings, and that'll give us a more robust insight into what's happening in the market. And of course, they will continue to be a positive result given, positivity because we've had rates on hold once again over October. So these are the results. 300 fewer auctions in Sydney. Sydney tends to be less influenced by A, the footy, and B, the holiday. Clearance rate was still quite reasonable, Graeme, just under 70% with 300 fewer auctions after what was a very good result the weekend before.
I'll tell you what, 75%. Still up, still nearly double last year. Saturday last year. Still a lot of stock selling up on the market.
That's right.
Okay.
That's right. That's exactly right, Graeme. And so sellers are confident. Why wouldn't they be? As I said, we're looking at double-figure growth this year in Sydney. Melbourne, just a handful of auctions as usual. They're all footy. 124 auctions, 60% clearance rate. You can see just a handful of auctions. We can't really take much notice of that.
Nah.
Brisbane public holiday, again, a 60% result. Not too bad for Brisbane. It's been a bit up and down lately. Adelaide, similarly, AFL state and a lower clearance rate, but just, as I said, a handful of auctions. And Canberra just tracking where it has been recently. So the monthly data is in now, just slightly lower. Sydney over September versus August, but still certainly a seller's market there, well above 70%. Melbourne has been a little bit softer, Graeme. We've put that up there that the Melbourne market's just been moving a bit sideways lately, but we'll look forward to seeing what happens over October in Melbourne. But certainly a market that bears watching at the moment, just been softening over recent months. Brisbane also, settled rather than softening, I think, that Brisbane market. But the latest house price data out of Brisbane is very positive, Graeme, as we've discussed. And the Brisbane market is a small market for auctions anyway and has a different culture in terms of marketing through auctions. Canberra just keeps on producing 80% plus clearance rates. A great market there if you're selling by auction in Adelaide, and Canberra just a little bit lower over the month as well. So you get those auction clearance rates and results every Saturday night around 6:30 on my LinkedIn channel. Welcome for those for all the capitals. And on Sunday morning, we also have the full national report. Sunday morning is released with the regional breakdowns for Sydney and Melbourne. So get a hold of that one on the LinkedIn channel. Free for all those that joined. And also, Graeme, as we finish our session today, we mentioned, as usual, the My Housing Market app, Infinity app, which is a good guide to what's happening in the housing market. It provides you with all the current data on properties that are for sale nationally. So every suburb that has a property for sale or for rent is listed in the app. Nice, simple little app, easy to use. And it will give you the median, the high and the low price and rent for that suburb. Also the number of listings, rental listings and for sale, number for sale for each of those suburbs. And you can also filter it, Graeme, for the type of property. So you can look for either a townhouse or a unit or a house.
Bedrooms.
And you can also filter it for the number of bedrooms, Graeme. How good is that? So you can look for a 2-bedroom unit in a particular suburb, and it will give you the high, the low, and the median, and the number of properties either for rent or for sale. So that's available through Infinity. Contact Infinity to take advantage of that great little app going forward. So next week we'll have the rent report, Graeme. Interesting. Just shows we had a remarkable collapse almost in vacancy rates over August, and that's, as we discussed, likely due to the surge in students coming into, particularly international students, starting the second part of the tertiary year. So we've actually seen a bit of a reverse in that, but still vacancy rates are very low. Look forward to that next week. August building approvals. We'll look at the building approvals and just a bit of a heads up on that. I think we saw a reverse in that, but we'll certainly look at the trends for building approvals and August home loans as well. And, of course, the latest weekend auction results, which will be interesting because we're back in town after the break. We've had Super Saturday and then the distracted weekend last weekend, and numbers will start to build up. And, of course, our next pause, Graeme, in our for our markets will be the pre-Melbourne Cup long weekend, the pre-Melbourne Cup Super Saturday, pre-Melbourne Cup long weekend Super Saturday at the beginning of November. So this is sort of the middle part of the spring selling season. So we'll see how things pan out, but certainly been very positive so far. But again, higher prices always start to work their way through buyer activity, and that's just the nature of the cycle, mate. What goes up steadies, and we're starting to see a steadying effect, but still some catch-up to do, I think, in most of those capital city markets, and certainly Brisbane and Sydney remain quite positive. We're just having a bit of a sideways look at what's happening in Melbourne. So I look forward to chatting with you again next week, Graeme.
Absolutely.
After what's been a very busy day today. Gee whiz, I think my voice is just about shredded, But
that's all that fuel. All that fuel we were throwing at the bank fire, mate.
That's right, the bank Bonnie.
The big bank bonfire.
Yeah, so we had a bank bonfire today.
We might name this episode the bank bonfire issue. We'll get some flames going around us. We'll get Maddie onto it.
Yeah. More to come.
More to come. Well, thank you as always, Doc.
My pleasure, yes.
And everyone in our community that is part of our community, if you reach out to the money coaching team, they will give you the password for Doc's app, which is very kindly exclusive to My Housing Market and Infinity. Or you can visit our private closed community group on Facebook. If you're a member, the password is in there for our community. Thank you as always, Doc. It's been a pleasure. And I look forward to next week.
Yes, I'm looking forward to a coffee. Let me tell you that.
Yeah, I bet. All right. I bet.
All right.
See you soon, Doc.
Mate. Yeah, bye.
Thank you.